Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, 1st of October. The US government is shut. The US yields and the US dollar are under pressure. Gold is trading at fresh all-time high levels while equity futures are in the red. But US government shutdowns do happen and they're not necessarily bad news for equity investors. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. Alright, so the US government is shut from today as US politicians couldn't agree on a plan to continue funding the US government. Now, this is not the first time this happens, and this is certainly not the last time. In numbers, since 1976, there have been around 20 government shutdowns in the United States due to funding gaps lasting at least one business day. And the average shutdown duration was about 8 days, and most of these shutdowns have been just a few days, and only a handful just lasted multiple weeks. And the longest one in the recent history was a partial shutdown, and it lasted 35 days. That was back in December 2018 to January 2019. Now keep that date in mind because I will be coming there just in a minute. But speaking broadly, the market impact of these US government shutdowns are not necessarily dramatic. Actually, it's quite far from that. For bonds, for example, the flight to safety tends to benefit the US government bond space. And because the US government still continues to service its debt despite being closed, well, the impact on bond prices is quite limited. If any impact, it is generally positive. This is what we see this morning with the US 10-year yield falling slightly on the back of the US government shutdown headlines. On the currency front, the US dollar tends to weaken when the US government is shut. As such, limited US dollar appetite and a softer US dollar index comes with no surprise this morning at the time I'm talking here. The Japanese yen and the Swiss franc that are considered as being safe haven assets, mass safe haven flows. The euro dollar will certainly test the 118 offers and could eventually clear this resistance if the US government shutdown lasts long enough, while cable could return above the 135 psychological mark, and that despite political shenanigans in the United Kingdom. And for equities, the impact of a US government shutdown could actually even be positive. Because in fact, the S&P 500 gained during the 3 of the last 4 government shutdowns in the United States, and it actually gained more than 10%. Yes, more than 10% during the 2018 and 2019 government shutdown that lasted 35 days, and that also coincided with a Fed pivot. So what I'm trying to say is that the shutdown is echoing negatively across US futures this morning, but keep calm because US government shutdowns happen and they are not the end of the world. The most annoying impact will be the delayed economic data, especially during a US jobs data week. But besides that, it will probably be business as usual. Now, speaking of economic data, jobs data yesterday in the US came in better than expected by analysts. And last month's figure was also revised higher. But just slightly higher, happily, and the job openings in the United States are now at the lowest level since 2021. So the data remains soft and doesn't necessarily change the expectation that the Fed is about to cut 2 more times this year before the year ends. Plus, weaker than expected consumer confidence data yesterday from the US and an unexpected acceleration in contraction suggested by the Chicago PMI back the dovish Fed expectations. As such, the US 2-year yield that best captures the Fed expectations is down for the 4th session. Today, the ADP, which is a private data provider, will release a September jobs report and is expected to reveal a weak print of around 50,000 new private job additions in the US last month. So even if Friday's jobs figures are delayed, yesterday's jobs figures and today's ADP figure could eventually give a hint to investors on the state of the US jobs market and keep them sufficiently comfortable about their Fed expectations, which are now quite dovish, mind you. So the thinking goes, a soft ADP read today, ideally softer than expected, should keep the Fed doves in charge of the market, pressure the US yields and the US dollar lower, and eventually give some support to equity valuations. While a stronger than expected ADP read today from the US could temper the dovish Fed expectations, but we wouldn't actually see major questioning or major pivot about the upcoming rate cuts unless we see a very strong print, and that would be a print around 150 and 200,000 job additions, which seems unlikely given the recent trend in US jobs market, but not impossible. So the more likely scenario here is continued weakness in US jobs figures with further selling pressure on the US dollar. The soft dollar has been actually a boon for precious metals. Gold and silver remain in demand and strongly in the overbought territory. The trade war, geopolitical tensions across the globe, waning appetite for the US dollar and for US treasuries, and now the US government shutdown are just a few arguments in favor of precious metals, and many out there actually believe that we are certainly not yet nearing the end of the present precious metal rally, especially in gold. So that view is also backed by historical data and technical analysis. But there is something else fundamentally actually supporting the gold rally these days, and it is about China. It's China that is gradually positioning the yuan and gold as alternatives to the greenback. So this is obviously not surprising at all, considering the actual geopolitical setup and the tensions between the US and China. But the way China is believed to do this is interesting and quite insightful, because there are talks now that China encourages its trade partners to convert their trade surplus into gold that it then holds in vaults in Shanghai. And assuming that 80% of the Chinese trade surplus, for example, is converted into gold, China would need around 15 to 20% of annual global gold production to accumulate in its vaults to back these trade surpluses converted into gold. And the higher the Chinese trade surplus, the higher the demand for gold, and the higher the demand for gold, the higher its price. So, the deeper you dig in the gold dynamics, the more supportive arguments you will find for the actual gold rally. So, no wonder gold is amassing massive inflows this year. No doubt that appetite is still quite tight, and that despite record high prices and overbought territory, and no question that gold miners are benefiting big time from the sustained surge in these gold prices. Frenilo, in this context, in London, for example, is having a stellar year, with its share price up by more than 300% since January. That versus just 110% rally for Nvidia, mind you, since the April dip. Just to say. In the same context, Zijin Gold International shares surged in their Hong Kong trading debut this week, marking the city's second largest initial public offering so far this year. Its shares actually jumped 68% yesterday during its first day of trading, giving the company a market capitalization of more than 300 billion Hong Kong dollars, which is equivalent of nearly 40 billion US dollars, the kind of performance that you would expect from a hot technology company IPO. Now, time will tell how long this gold rush will continue, but for now, there are more arguments in favor of a further rally than the contrary. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.